let's start very top down. I see you do a lot of content and you focus on this idea that this has been an income-driven expansion. But let's take a 30,000 foot view of where we are in terms of the US economy. What's your take on how things are progressing?
Yeah, I think over the course of the last couple of years, I think those folks who focused on this idea that we have, as you described, an income-driven expansion, have had the benefit of a real non-consensus view. First, initially recognizing the economy is likely to be stronger than most people expected, but now starting to see how that income-driven expansion is weakening, and as a result, now starting to shift their views to become a bit more bearish on the U.S. economy than is consensus. And really, when I describe an income-driven expansion, it really comes down to sort of old-time expansion principles, which is what generally drives household spending is income growth, and often what drives income growth is consumption growth by households, and that isn't a spiral; it's just a self-reinforcing dynamic. And what we've seen over and that generally hasn't been the story. Generally, credit has been a big story in the U.S. economy over the last 20 or 30 years before this cycle because borrowing was so important. But what we've seen in the post-COVID economy is very limited borrowing and much more income-driven dynamics. And what we're seeing today is a real slowing of that. If you look at what's happening with wage growth, the weakening of labor markets has now driven wage growth per worker down to about 3% on an annual basis. At the same time, the combination of restrictive immigration policy and just general labor market softness has brought labor force growth or labor job growth down to about zero. And so you at some level, the math is pretty simple, which is if you have 0% job growth and you have 3% wage growth per worker, that's 3% nominal income growth in a 3% nominal in a 3% CPI or 3% inflation environment, gets you 0% real demand. And that's basically what we've seen in the economy since the beginning of the year is 0% real demand. And the US economy will not hold up in a 0% real demand environment. And certainly 0% real demand is very different from what's priced into stocks in particular, but also into the bond market right now.
All right, so a lot I want to go off of that, but okay, let's keep going on this income-driven expansion. When I hear income-driven expansion, I'm thinking, well, sure, if there's bargaining power, then labor is going to want more income. You had a lot of that post-COVID, but now you've got this interesting intersection where AI is starting to interfere, right? So talk me through how you see future income-driven expansions in an age where AI is getting more and more accelerated.
Well, I think AI is like any other technological innovation from an economic mechanics perspective, very important, which is to the extent that a labor saving technology means that you have less labor. It also means on the flip side that you're paying people less money in terms of their earning income, right? And that's where I say, one man's income is another man's spending, which is that ultimately in the US economy, there are only two sectors that spend at the endpoint, which is either households or the government, right? And the government mostly engages in transfers. It mostly doesn't do outright sort of GDP spending. And so really what it comes down to is, okay, what happens to household income? Because household income translates to household spending. They're ultimately on the hook for the spending. And so I think the challenge with particularly those folks who are, let's say, the tech mega bulls, they'll talk about, hey, businesses are going to have radical margin benefits from AI. And the answer is, okay, that's great. Maybe they do, but somebody's got to pay for that benefit. Because if you just take a simple business, sure, any one business can fire half its workforce and replace it with AI. But unless those people get additional income, the aggregate sales in the economy soften, and therefore you have an economic slowdown. And so I think that's the real question is, what is the benefit? How big a deal is the AI thing going to be? Which we could have a discussion about. But really on the flip side is, if it creates a lot of job losses, who is going to make up for that spending? Because if someone doesn't make up for that spending, there is no actual benefit on the top line the top line will slow, and that will be detrimental to business.
You said the slowdown in income-driven expansion is not priced in to stocks and not bonds. I think we got to expand on that because I myself have been on this point for the last 2 years that everyone looks at the stock market being the S&P. Meanwhile, small caps are halfway through a lost decade. Right, Russell 2000 basically has gone nowhere. You can argue that's much more closer to the U.S. economy and consumer. Obviously, there's a tech aspect to that, a style aspect to that as well that explains the bifurcation. But when you say that a slowdown in income expansion is here, which part of the marketplace is discounting it more?
Yeah, I think this kind of goes to like me as a macro guy and a macro perspective. If I just think about what has driven the equity market, and when I say the equity market, like the market cap weighted equity market over the course of the last couple of years, I think a lot of people will be like AI, innovation, all sorts of stuff. I look at it and I say, no, none of that stuff mattered. What happened was growth expectations were super soft in 23 and 24, and the economy was decent. And as we look at the markets today, essentially growth expectations are quite high, meaning like, sales growth, earnings growth, all that, they're all very elevated. And the real economy is slow. And that is setting up a dynamic for weaker aggregate equity returns. And we get lost in lots of individual stories, but if you're a macro investor and you look at what drives the single most consistent descriptor of what drives equity returns is how conditions come in relative to expectations over the subsequent 12 months. That's it. That is the most consistent driver of equity returns over time. Doesn't mean the most consistent driver over a day or a week or a month, but it does mean over something like a 12-month time frame, which is what most people care about. That is the most consistent driver, and that's the divergence that we're seeing today.
Let's apply that to the bond market. And in the same way, there's a nuance, right? You've got duration, you've got credit. I think people, when they talk about bonds, they often don't think in those two terms. Treasuries obviously have had a very different performance than junk debt, as an example, over the last several years. Talk me through sort of the way you view bonds here.
Yeah, so I think if you look at the treasuries, when you say bonds, I think treasuries. That's what I'll say as a macro guy. I think treasuries. At a big picture level, like basically what we have is we have yields that are at cyclical highs at a time when the economy is slowing, and that is typically a good time to buy bonds. It is probably further exacerbated by a frozen Fed. Now that's a little counterintuitive because you're like, typically, if the Fed is easing, that's good for bonds. But the reality is, if the Fed isn't delivering monetary policy, if monetary policy is tight relative to aggregate slowing, that's actually a good scenario for bonds, meaning because you're going to have weaker economic conditions relative to what's priced into risky assets, and that should create a bid for long end bonds. And so I think that's the sort of fundamental divergence that we're seeing in the bond market, in the treasury market. One of the interesting things, if you go then to credit, and I often think about this thing, kind of separating the two, which is between the treasury component and the credit spread component. Actually, credit spreads, of all the different growth assets that are in the US economy, credit spreads are actually one of the cheapest buys of growth. Meaning, if you look at high yield credit spreads, yeah, they've compressed and they're kind of low relative to history, but the credit quality of those credits has improved a ton. And if you factor in things like, volatility and fundamental cash flow measures, you kind of see like credit spreads are kind of high yield credit spreads are kind of neutral relative to history, whereas equities are radically elevated in comparison to history.
So I think that's an interesting perspective, because it would argue that if you're going to be bullish on equities, but you want to be relatively, in quotes, safer, which we know is a loaded term in our business, that high yield is probably the better place. But it does beg the question of, sure, they might be neutral, but are they also vulnerable, right?
Yeah, and I think the challenge with holding equities at this point is you have to have very high growth in order to meet those expectations, very high earnings growth. And so even like fine earnings growth would be below those expectations and would likely be detrimental to stocks. Whereas when you think about a credit risk, It's the downside component of credit risk is really around an acute recessionary environment. And what we're talking about here is not an acute recessionary environment. We're talking about here is growth that is slower than very elevated expectations, right? I know it can sound subtly different, but it is actually meaningfully different in terms of how those two assets play out. And so you're right, like they will trade the same in a, in a left tail negative growth environment, but they will trade pretty differently in merely a slower than expectations environment. And I think that's kind of where we're at ahead.
I'm sure you've seen a lot of the same data as a lot of people here that look at 10-year forward return expectations when your starting valuation is where it is for the US markets. And it's not exactly encouraging for the long-term equity investor. But the reality is a lot of people don't think in those terms. They think very short term. The reality is, things are still going up and there's still a lot of optimism around Trump, tariffs be damned, all this. At what point do you think these elevated valuations matter?
Well, I think they matter in one of two cases. One in which the hard macroeconomic data is so overwhelmingly obvious that you're having a disconnect between what's in the market and what's priced into the market and what's actually happening in reality. Or two, it's reflected in earnings. Now, those things are related to each other, but ultimately, the weaker real economy conditions are likely to be reflected in weaker earnings growth. If you're a macro person, you kind of see those two things connected, meaning like if you see that retail sales is flat over the course of the year, your real retail sales is flat or real PCE is flat over the course of the year, you're probably not going to get a lot of earnings growth in retailers in the US economy. That connection is relatively straightforward, but it may take actually getting weaker than expected earnings growth to play out before that recognition happens. And I think part of this is really, it's about timeframes. Like, I run into this conflict as a person who was running portfolios from a macro perspective at $100 billion hedge fund. We couldn't think about trying to pick off 5% moves in the stock market. To be frank, 5% moves in the stock market didn't matter to us. What mattered is we had to position ourselves over the course of a period of time, over the course of weeks or months, in terms of how the economy was going to play out over the subsequent 3, 6, 9, 12 months because of the way in which we had to position. And so that's really where I'm always thinking is, okay, where are we likely to be 6 months forward relative to what's priced in? Like what's happening, stocks go up 5%. I don't know, stocks go up 5%, they go down 5%. Who cares? If you're playing the game where you're trying to pick off 5% stock moves, like you're going to spin yourself up in circles because there's not a lot of signal in those sorts of shifts.
You use the term position. A lot of people are not positioned for international markets to run. And I want to get your thoughts on how the economic state looks for anything outside of the US. I know that's very broad because you're talking about Asia, Europe, obviously Latin America. But let's talk about international economics and then international equities and then positioning within that.
Yeah. I mean, I think, it's interesting. If there wasn't this tariff story and this immigration story in the US, what we would be talking about would be a global coordinated fiscal and monetary easing, right? And one that in some ways has pretty peculiar characteristics, which is what we're having right now is a global monetary and fiscal easing in an environment where growth is actually not that bad globally. Like, it's softer than coming right out of COVID, but like global growth is like 2.75, 3% real. Like that's pretty good. And layered on top of that, a big monetary and fiscal easing should be supportive to growth particularly outside the US. And so it is a bit of a weird circumstance where the US is running like very negative growth policies with a frozen Fed. And at the same time, you've got all of this easing and stimulation happening elsewhere. And, that is, a dozen cuts from the ECB. That's the UK starting to ease. That's Japan continuing to run monetary policy that's easier than expected. Sorry, no yen carry squeeze for you. That's China. Had to slide that in there. Just that's China running big very easy monetary policy and expanding their fiscal positions. Like it's kind of everywhere, and that generally is a decent growth and lots of easing is generally a pretty good time for equity markets. That's whenever you're looking at it, it's a pretty good time for equity markets.
A question from Mikkel talked about prospects for a sovereign debt crisis. Now, I remember 2011, you had a lot of concerns around a sovereign debt crisis sparked by Greece. Now you've got a lot of people talking about a sovereign debt crisis sparked by the U.S. Given deficits. It's always been odd to me. It's like everyone always talks about U.S. government debt, but nobody says at what percentage of GDP is the marginal line, right, where the things kind of really tip over. So, I mean, what do you think? Are these concerns around a sovereign debt crisis in the U.S. and maybe even overseas valid? I mean, what's your thoughts there?
I think a lot of folks are maybe not as crisp about delineating sovereign debt crises in places like Greece, Argentina, et cetera, and places like Japan and the US, et cetera. And there's an important distinction between those two cases, which is, Greece had a large external debt stock in a currency they couldn't print themselves, right? They were relying on the ECB. Ultimately, they actually resolved it because the ECB printed a bunch of money and transferred that money over to Greece and was able to absorb the debt without an explicit currency devaluation. But that's that sort of, let's call it credit, meaning borrowing in a foreign currency and then not being able to pay back, is a very common a debt crisis that we've seen through history, but it is a totally useless framework for thinking about developed world sovereign debt in currencies that you can print. And so I consistently go back to kind of the same question when people bring this up, which is, okay, tell me which country in the world has the largest, which large developed world country has the largest debt stock? The answer is Japan. We all know that. Which country has the lowest, which of those countries has the lowest benchmark interest rate? Let's say 10-year interest rate. The answer is Japan. Okay, well, so what are we talking about here? And the reason, what we're talking about here, the reason why Japan can have both the highest debt and the lowest yield is very simple, which is that the BOJ has bought as many bonds as necessary to ensure that the interest rate is appropriate given the economic conditions. And there's no reason to believe that the US wouldn't do the same thing. Now, that doesn't mean that yields can go up, they can go down. It's not that big a deal. But ultimately, the Fed has a put on the bond market. What that means, though, that put on the bond market is that weakness, that need for a weak real return on bonds because of the over indebtedness, it has to come out somewhere. And the way it works out, the way it comes out is that giving on the currency, and particularly giving on the currency relative to other things, relative to hard assets that people aren't necessarily benchmarking against. So whether it's gold, we could argue about Bitcoin, but certainly gold is a very clear one. What we're seeing globally is gold is going up against all highly indebted developed economies that are facing this sort of circumstance. And so much more likely that we see bonds, let's say bonds relative to cash, returning fine, mostly in line with economic conditions, at a time when these currencies are being devalued relative to hard assets, whether it's gold or other, physical assets as well.
So about tariffs, everyone's favorite topic, tariffs, which again seems to be oddly bullish for international markets, at least when you look at those stocks. Where are we on tariffs? I mean, I can't keep up, man. When I'm with these heads, I have no idea. And I'm like a chick with that head most of the time when I'm working, and then I see tariff. Yeah, Trump's doing a tariff here. He's like, Oprah, you got a car, you got a car, you got a tariff. I mean, what's going
on? The way I describe this is we have moved from a no tariff environment, by and large, to a high tariff environment. The magnitudes of which are uncertain, but the direction of which is pretty clear, and that we are just getting started in terms of feeling the effects of that. The reason why that is that there's some mechanical reasons why it takes reasonable amount of time from when a tariff policy gets announced to actually when the tariff is collected, because the tariffs only they take some time from announcement to effect. They take some time because they only affect newly loaded products onto boats. The boats have to get over to the US. And then there's a delay in the actual payment of the tariffs up to 45 to 50 days because of the way that the CPB does the actual payments, which I know is getting into the weeds. But long story short, what you see is like, you could announce a tariff today and it can take something like 3 to 4 months to actually get collected. And then on top of it, it can take 3 months, 3 to 6 months to actually get that product on shelves. So this is a very long, slow play thing. So people are like squinting at, CPI data in April and are like, there's no tariff impact. It's like, yeah, of course there's no tariff impact. It takes a long time. And so what I'd say is we're moving in that direction. That direction, a tariff is a tax. It's that simple. We see no indication that foreign producers are paying the tax by reducing their prices. All indications are they're maintaining their prices. That means the tax is going to either be paid for by U.S. businesses or U.S. households. And just like any other tax, it's a negative growth impulse on the economy that's likely to be in the ballpark of 1.5% to 2% of GDP. And as a result, that's a pretty big tax hike that exists on the economy. Like, it's multiples of the relatively marginal tax cuts that exist in the Build Back Better, or the Big Beautiful Bill, I should say. It's many multiples of what's there, and that stuff is out more in 2026 than in 2025. So it's a negative growth policy. It's a negative shock. It's a rise in taxes. It's going to be with us for an extended period of time. Could it reverse? Yeah, of course, anything could reverse, but it seems like, if you look at even the consensus, like smart investors consensus, like basically everyone's accepting we're going to be in a mid-teens to as high as 20% tariff environment for the foreseeable future. That's kind of the consensus expectation.
Yeah, and I'd argue that because people's attention spans are so short now, the alpha really comes from that lag, right?
Right.
And that patience and positioning in advance. So in many ways, you can make the argument that markets are far less efficient long term than they used to be because there's no respect for the lag.
Right. I mean, if you talk about, hey, look, there's going to be a tariff effect, that's going to cut down household consumption by 2%, 3 to 6 months from now. People are like, yeah, but stocks were up 12 basis points yesterday and you're a moron. And it's like, okay, well, there's not much you can say about that.
This is why I only put my replies to those I follow on X now. Right? That's that and the bots, right? But I love that slip you did. You said Build Back Better, but actually big beautiful bill. And then I'm thinking to myself, the commonality is triple B, and then maybe where our credit rating is going for the U.S. So
Yeah.
let's talk about the big beautiful bill a little bit here, because it's pretty big. I don't know if people really are aware of like the magnitude of the pork and all the stuff that's gone in, but which is, you can argue, typical. And also why Elon Musk is now trying to form another party and all this. But what do you think the implications are on the big beautiful bill? What are some things that you think are not getting as much attention there?
Well, I think first of all, I think the political rhetoric is like confusing to people because it's described as the biggest tax cut that the U.S. has ever seen, and from a macroeconomist perspective, it's like the biggest the biggest not tax hike that the U.S. has ever seen. Meaning, like, it's basically just a continuation of current policy. That's it. Just big picture. It's not that much different from that. It's kind of like existing tax policy will exist in the future. There are some, frankly, nuances beyond that from a macro perspective that some of which are beneficial, meaning like there's some incremental reduction in taxes on tips and Social Security and some expensing, accelerated expensing for investment in plant and equipment, which are marginally, we're talking like pretty modestly, like 0.1% of GDP beneficial to growth. And then on the flip side, there are cuts to social services, particularly in cohorts that are, high propensity to spend groups, like things like the Medicaid cuts and things like that, which are a few tenths negative. And the dollar value of the benefits are likely bigger than the dollar value of the cuts, but the cuts are for people who would be more likely to spend the services. And so the net effect is like kind of zero, which I know is kind of boring, right? It's like there's all this stuff, and the gist is it basically has no effect on the economy when you net it all out. And that, that's what it is. That's from a macroeconomic perspective. You just added all the effects up, and it's kind of like a zero. And so I highlight that because at the same time, you have essentially one of the fastest tax hikes that the US has ever seen with the tariffs. And you have one of the greatest constrictions of labor supply and immigration that the US has ever seen. And so those are two very big negative growth policies at a time when kind of everyone's focused on the big, beautiful bill, which is kind of a zero when it comes to the macroeconomic implication.
Do you believe we continue to see an elevated inflationary environment for the foreseeable future due to tariffs and/or an increase in M2? Also, any commentary around Treasury buybacks and issuance schedule? Here we go with Yellen 2.0 under administration, right? Continue to roll bills to fund deficit. So look, let's take a step back. This has been a concern a lot of people have noted for the last year and a half, that now is around the time when you've got a big rollover and you're going to roll over into much higher interest expense. Right. And there are concerns that that's going to choke the economy, although maybe not. Right. Because who knows? But yeah, let's riff on that for a little bit.
The debt profile of US issuance is an important component of aggregate financial asset supply and demand. If you just think about it, like selling bonds is just like selling assets, and somebody's got to buy them. It's that simple. And there's a big difference in the financial markets between issuing a bill, which is essentially like cash, and the riskiness that's perceived there. It's like essentially cash adjacent, versus issuing, a 30-year bond, which has got a lot of volatility, and you essentially have to accept greater risk. The question really is whether or not we see a shift of that debt profile in terms of the duration, the typical duration or average duration of the issuance of the US. If they shorten it, that's actually good for financial assets because it means that there's less, risky asset supply. If they lengthen it, it's bad for financial assets. There has been, I'd say, there's some questions about what's going to happen. The president, in a unscripted meeting, press conference, around the desk, said we're going to stop issuing any debt over 9 months. Now, that did not actually translate into the Treasury auction schedule, the subsequent Treasury auction schedule. So it's not really clear whether that's a flippant remark made, in anger, or whether it was, a flippant remark made with no consideration, or whether it was actually administrative policy. One of the ways in which we'll see how that plays out is in the QRA announcement, which happens at the end of July, which is where the Treasury basically officially outlines what its mix is going to be ahead. Its issuance mix is going to be ahead. The reality is, like, so few people look at the QRA or even understand what its implications are. You don't have to bet ahead of time to figure out what's going to happen. Like, wait to see what happens in the QRA. It will take time to flow through the markets. You can respond in position once you see what the policy actually is, and you'll be in good shape. And it'll be interesting to see, are they going to cut duration issuance, or are they going to keep it the same? Probably not going to extend it. Bessent has already made that clear. They're not going to extend it. But if they keep issuance supply basically the same, then, this is a nothing thing. If they cut it significantly, then that's good for financial assets. It's good for stocks. It's good for gold, and it's likely bad for bonds.
Some analysts have suggested that we're going to see a deflationary market event later this year caused by a Fed policy error, rates too high for too long, and deportation. Your thoughts? I will throw in there, and maybe reverse carry trade. I know we go back and forth on this. Although it is interesting, I will say something about this. And maybe this is kind of another sort of interesting side question, which is, do deflationary pressures have to be an event at this point, because there's just constantly reactions that prevent a prolonged deflationary cycle?
Yeah, I mean, I think I'd probably describe it. I think people can mix deflationary environment with weak growth environment. And what I'd say is, I think we are shaping up for a weak growth environment. whether that's deflationary, I mean, in general, weaker growth conditions are disinflationary, right? They generally bring prices down. It's complicated. Honestly, it's complicated to know how this is all going to net out because we have the tariffs and that's inflationary, and you have, weaker growth environments and that's on the margin disinflationary. And so what I'd say is kind of like the range of inflation at some level is not that interesting because it might be, and it's also kind of depends on how it gets measured and all that stuff. Like, are we at 3.3 or 2.5? Like, who cares? It doesn't really matter. The real question is, are we going to be in a negative growth environment? And in response to what you're saying, like, odds are a negative growth environment will not persist for an extremely long period of time because frankly, policymakers have learned that there are tools that they can use to be responsive to that. But it's important to recognize that the way this works is first you have a negative growth environment that affects asset prices, and then you have the reflation, right? And I think a lot of people are like, well, the Fed will have yield curve control in a negative inflation, a negative growth environment, therefore buy stocks. It's like, that's not how it works. First stocks go down and then they respond. That's how it works.
Yeah, and the mechanism also there is around credit spreads blowing out, which is why they never stepped in the midst of that tariff tantrum, right? I mean,
Right.
which is
Right.
part. I mean, I remember on that Saturday or Sunday, I was watching Bloomberg, and futures were down 1,500 points. It was a Sunday, and on Bloomberg they had Norio Rubini, and he said, "But I myself have argued, I think you as well. It's like, why would the Fed step in? Spreads were barely budging in the midst
Right.
of the panic." So it all goes back to that. Going back to markets, views on the impact on global liquidity rising, supportive, dominating other macroeconomic data for assets. So I'm sure Michael Howell. His global liquidity framework is a very popular one,
Yep.
and it does seem like everything's driven by liquidity and fundamentals be damned as well. What are your thoughts there?
Well, I think I mean, what I'm describing about the coordinated monetary and fiscal easing, I think is consistent with and the primary driver of the high liquidity environment that's going on right now. Um, I think the question is who gets the benefit from that liquidity, and the reality is, the U.S. has gotten the benefit of that liquidity for a long time, for like 15 years. And as a result, you've seen asset markets rise a ton, but that has required a lot of foreign investors to basically be extremely overweight US assets along the way. And instead, I think what we're starting to see is those investors are starting to pull back on their extreme overweights of US assets. It's a sort of process that takes a long time to play out because you got to change, if you think it, US policymakers are slow. Imagine like being in a European, pension fund allocator. I mean, we're talking about it takes years for this stuff to play out. Just in the same way it took years for them to build up the position, it'll take years for them to move in the other direction. And so probably what we're going to see from the US perspective is that drag from the withdrawal of overweight US positions is likely to offset the global liquidity benefits plus the the negative growth policies in the US, those are likely to offset what would be sort of the leakage of global liquidity in. And it's one of the reasons why holding foreign stocks relative to US stocks, if you're going to hold equity risk, it seems much more compelling to hold foreign equity risk than it does holding US equity risk right now.